Hello, beautiful people, and welcome to another edition of the ITU Forex class. In this week's episode, we're actually going to be talking about how to use the MACD indicator. Okay, so the MACD indicator, for those of you who don't know, is actually classed under the oscillators category of technical indicators. Okay, so basically, when you hear traders say an indicator is an oscillator, it usually tends to, for those of you who have done physics in high school, usually tends to have readings that bounce between 0 and a certain amount of a certain number. Okay, so this group of technical indicators include indicators like the stochastic oscillator, the relative strength index, and all of them kind of indicators. Okay, so there are actually lots and lots of ways that traders tend to use the MACD indicator, but I personally prefer to use it for mean reversal trading strategies, for reversal trade setups. Okay, so what exactly are reversals? Okay, to do a quick example which would help you understand exactly what we're talking about here, reversals usually come at towards the end of a trend. Okay, so in a normal trending market, usually what you'd find is price is going to make higher highs. Okay, or let's just start from the beginning. Price is going to move from a low point and then it's going to make a high. Okay, so this is the origin low and this is the origin high. Okay, so after this gets printed, usually what tends to happen is if the market is in a trend, in this case an uptrend, price is usually going to retrace its steps, but that retracement is not going to be, it's not going to be so deep that it's going to move lower than the initial origin point, because if it does that, then that's no longer a trend move. Okay, because it's a very deep retracement, and even if it was to be a trend, that would kind of mean that the retracement is very deep, so that would not count as a trend, as a healthy trend. Okay, so usually what tends to happen is if the move we're analyzing is a healthy trend, it should have no business coming all the way back down to the initial point of the move, or the lower high or the lower low, or whatever the case might be, depending on the direction of the trend. Okay, what you would see is if the market is in a trend, then if it's an uptrend, it's usually going to move from the lows, then it's going to form a high, and then it will retrace its step. Maybe depending on the depth of the strength of the trend, is usually going to retrace itself from between 0 to 100% of the leg of that move. Okay, so once it does that, it's usually going to experience some rejection at some point within the move of the extension move, and then it's going to, after that rejection is it experiences that rejection, price is, if the trend is healthy, price is most likely going to continue moving in the direction of the trend with a move that's so strong that it's even going to break above the resistance where it found difficulty to break before. Okay, to break above before the retracement began. Okay, now this is for a healthy trending market. And in a healthy trending market, what we expect is for price to continue making higher highs. Okay, this is our high, this is a higher high, and this is a low. This was our initial low, and this is a higher low because this low is higher than this low. Consequently, this low is also higher than this low. So if this is truly a strong uptrending market, price is going to continue forming higher highs and higher lows. Higher highs and higher lows. But like with anything in trading, trends don't last forever. Okay, it would be nice for you to catch a trend that just keeps going and it never turns back, but that's not the reality of trading. More often than not, what you're going to find is that price is going to, at some point in time, face a level where it finds very, very difficult to break above. And so when it does this, price is usually going to maybe just slightly break above that level, or it might struggle to even retest that level, to the T, or it might just slightly test that level and then it's going to fall apart. Okay, and then it's going to move from making higher highs and higher lows to now failing to break above the previous high to form a higher high, and all of a sudden breaking below the higher low to now start moving in the direction of the opposite direction. So this could be the start of maybe a move in the opposite direction of the trend. So if we were in an uptrend, this move could be the start of a downtrend. It may be a large downtrend or a temporary downtrend, or maybe price might just consolidate or just range. But whatever the case might be, the trend is not just going to continue moving indefinitely to the upside forever. Okay, and so the type of method that I like to use the MACD indicator to identify trade setups is for the moments where price, let me do this, is for the moments where price is actually going to find it difficult, okay, to continue moving in the direction of the trend, and then that trend is likely going to reverse. Okay, that's what I mean by reversal trading. When the market is moving in the direction of the trend, that's trend trading because we are moving in the direction of the trend. But when we have a reversal, then obviously that's a reversal. Okay, so moving on. So to add the MACD indicator on your charts, if you're using the MetaTrader platform, all you need to do is just click on the navigations bar, click on insert, and then hover your mouse's cursor over indicators, and then hover your mouse's cursor again over the oscillators category of technical indicators, and then select MACD. You can see it, MACD. It just stands for moving average convergence divergence. Okay, that's just what it means. Okay, so all you need to do is just click on it, and you could use the default settings. The color here, which is silver, is for the histograms. I tend to find that the silver color is not, it doesn't make it appear more clearly on the chart. So I just use the color black. You can leave it as is, or you could color it whatever you want. It doesn't really matter. It doesn't affect the calculation of the indicator. This is the default settings for the indicator. We have the fast EMA as 12, the MACD line, the signal line, I think is 9, and then the slow EMA is 26. This is the default settings. You don't need to change anything, okay? So I just click on OK. Now, the way you use, once you add it onto your chart like this, this is what's going to look like. This is what it's typically going to look like. These black bars that you're seeing are called the histogram. Okay? And the red dotted line that you're seeing here is called the MACD signal line. Okay? So there are, like I told you, there are lots of ways that traders tend to use the MACD indicator. Some traders, you can see that when the histogram is here, it's below this imaginary line in the middle. This is called the zero level, okay? So the way some traders tend to use the MACD indicator is whenever it goes from, forming negative histograms, you can see from the zero level down here, all of the readings are negative, okay? So when the MACD indicator goes from forming negative histogram lines to starting to form going above the zero line and starting positive histogram lines, some traders use that as a positive signal to go long on a pair. And you can see from an example of this, if you were to trade it based on this particular simple method, if you were just to wait for this histogram to go from negative to positive here, and you took a long trade when this signal would have occurred here, you would have taken a trade with, a very good, that would have been in a very good amount of profits. And again, if we were to go from when the MACD histogram lines were positive and then it went to negative, and then you would have taken a short trade somewhere around here, then obviously this would have also been a profitable trade. But this is not the way I like to use the MACD indicator. And one of the reasons why I say this is because one thing I've noticed with the thousands of chart time that I've had in my career as a Forex trader is when you're using the MACD indicator in real time, the histograms sometimes tend to repaint based on market price action. So you might see the histogram going from negative to positive or positive to negative. And then when you take a trade setup and, price just violently moves to one direction or whatever, you might be left stranded when you see the indicator will just repaint as if what you saw was not there. Okay, so it's like, it's playing games with your mind. And that's why I don't like to use just the signal of the, histograms going from positive to negative or negative to positive to take trade setups. Some traders use it perfectly fine. It works for them. Awesome. But I personally don't use it like that. Like I told you, the way I use the MACD indicator is to identify where there are likely going to be reversal points in the market based on divergence, and then I take those trades. Does this mean because I said this is the way I use it, that 100% of the trades I take are going to be winning trades? Obviously not. That's not the way trading works. I've said this countless times on the channel. You don't need to win all of the trades you take to be profitable. It's trading. You need to make peace with the fact that losses are part and parcel of this business. Okay, so you're going to encounter losing trades whether you like it or not. you can't just run away from it. The only thing you can do is to prepare for them. And how do you prepare for them? You prepare for those inevitable losses by practicing proper risk management, keeping your risk consistent. If your risk is 1% per trade, never increase that if you don't know what you're doing. If you know what you're doing, obviously, maybe you're doing a dynamic risk management. When you're in drawdown, you reduce your risk, or when you're in profits, you increase your risk, or whatever. That's a totally different thing. If you've back tested it and you've proven that it works for your strategy, awesome, go ahead with it. But if you haven't, and you just did a simple back test of your trading strategy and you're just risking 1% per trade and it turns out to be profitable, when you're trading in the live market, don't stray from it. When you encounter a couple of losses, don't revenge trade and start risking 2 or 3% because you want to recover your losses, with one trade or whatever. That's it. Just more often than not, that just gets worse. And even if that trade that you over risk on, over leverage on, turns out to be a winning trade, that's just going to encourage bad behavior, which will eventually catch up to you and bring devastating losses that would be very hard for you to recover from. So whichever trading strategy you learn, or whichever trading strategy I teach you, I want you to have it at the back of your mind that no matter how good I make it sound, okay, you're not going to win 100% of the trades you take with it. That's just not how trading works. Okay, have it at the back of your mind that no matter how good a trading strategy is, it's going to have winning trades and it's also going to have losing trades. The way traders survive in this business is when they get losing trades, they try as much as possible to keep a cap on it, to keep a limit on it. And this is where you hear traders saying, cut your losses short and let your profits run. Because if your losses are always in check, then they're not going to cause you, to blow your account. And if your profits are reasonably larger than your losses, then eventually, even if you were to win just a fraction of the trades you take, those winning trades would be more than enough to cover, the profits from those winning trades would be more than enough to cover for the losses of those losing trades. Okay? And that's how you make it in this business. I told you, most of the trading strategy that I use to trade the markets profitably, their win rates are usually less than 50%, maybe 40 something, and they work quite well. Okay? So moving on. So the way I use this indicator is, like I told you, I use it based on divergence. Okay? I explained to you the logic behind it and everything. So let's go back to the drawing board so that I can explain to you how I use this. So remember I told you that usually in an uptrending market, what tends to happen is that price is going to go from a low point to a high point, and then it's going to pull back. And then it's going to keep forming higher highs and higher lows. Higher highs and higher lows. Higher highs and higher lows. If this trend is healthy, then price is going to continue doing this, for as long as it takes. But eventually, like I told you, the momentum is going to weaken. Now, the MACD indicator tends to spot shifts in momentum. So let me give you an example. Let's say that price moved from this point to this point. This was the move in the direction of the trend. And let's say this move was like 100 pips. It covered 100 pips. And then this same move also, price moved from this point to this point. And this move is also, give or take, around 100 pips. But if, for example, it took, let's say we're on the 1 hour time frame, okay, and it took around 10 candles for price to move from this level to this level and from that 100 pip move, but this move, price took around from this level to this level. It's the same 100 pips, give or take, okay, but it took it like 20 candles. This on the MACD indicator or any other oscillator is going to show you that this move is actually much stronger because it has more momentum behind it. Why? Because price moved 100 pips within the time period of only 10 candles. So if we're talking about the 1 hour time frame, it only took price like 10 hours to actually move a distance of 100 pips. But when you compare that move with this same move in the direction of the trend, which is give or take the same 100 pips, just like this move, but then price took around 20 hours to do the same move. Again, it's like, let's just use a simple example. It's like you and somebody are trying to, you're competing with each other, okay? And you're trying to take a couple of buckets of water up onto a mountain, okay? And then let's say the first person, he took 2 buckets of water, or let's just say you take 2 buckets of water, okay, from the bottom of the mountain to the top of the mountain, which is, in this example, let's just say something like 100 meters, for example, okay? And you do that within 10 hours. But then the other person you're competing against, when it's his turn to do the same thing, he actually goes from the bottom of the mountain to the top of the mountain, the same distance you covered, but it took him 20 hours to do that. More often than not, people are going to say that you're the stronger one because you did it in, half of the time that it took him to do the same thing. And this is what momentum indicators tend to look for. When they see that price moves a certain amount of pips in a certain direction, but then the previous move that it's comparing that to did it in less time than it did, this is going to tell you that the momentum in the market is actually stronger or it's weaker. That's all oscillators are trying to tell you. Now, going back to our MACD indicator example, okay, how does this reflect on the chart? Well, here's what you want to see, okay? You can see, for example, this particular move, okay? This particular move, price move from here all the way to here. So we're forming lower lows and lower highs, lower lows and lower highs, obviously, okay? So price move from this level to this level, and it took it like, let me pick my cross here to make it easier for us to see these things, okay? So price moved from here to here, and it moved a distance of around 160 something points. 1,000 is 165 pips, but since it's points, it's going to show you 1,654 or whatever. So in this case, price actually moved a distance of like 160 something pips, and it did that within 30 bars. So it took it like 30 hours to do this move, okay? But then compare this to this move. Let's say this same move, okay? Price moved from here to here, which is a distance of, let me quickly move this tool around away from here. So price moved from here to here, and this move was like 190 pips. And price moved this distance in only 23 bars, which is like 23 hours. Now, can you see exactly what I was telling you about oscillators? You can see that when price was showing that the momentum is to the downside on this histogram, you can see that it showed you that price is actually, yes, moving to the downside. But then when you compare this move to this move on the histogram, you can see that this one is much lower than this one. This one is much lower than this one. Why? Because price covered more distance in less time. So this is telling you that there's stronger momentum in the market for this down move than there is for this move, up move. For this down move also. They are both down moves, bearish moves. But then this one has more momentum because it moved more distance in pips in less amount of time. That's all these oscillators are trying to tell you, okay? Whether it be the MACD, whether it be the stochastics, whichever oscillator it is. The reason why I'm taking my time to explain this to you is because when you understand the logic, what these indicators are trying to tell you, even without having the indicators on the chart, you automatically understand what the market is doing. So if, for example, somebody was to tell you that, okay, price is moving in a downtrend and whatever, and you kind of, if you take some time to study this, you kind of get a feel of how strong a trend is. Okay, so let's say, price moves in the direction of, let's say, a down bearish trend, and then the first 10 candles moves like 100 pips in 10 hours, and then the next one moves like, you get to see how strong the momentum is. So if you want to take a trade in the direction of the trend, you can gauge to see the strength of the momentum behind that move based on how price has been showing itself, and then it's going to, that intuition, with a lot of screen time and backtesting and all of that, that intuition sometimes will play a part in how you place those trades and, create more case for the trade setup you are going to take. Okay, but that aside, we're mechanical traders for now. Let's move on with the mechanical example. What do I do with this MACD indicator? So again, like I told you, I use it to trade based on momentum. Now, look at exactly what I'm talking about here. This is a trade setup, but again, this is just to show you, the market is closed obviously now, but this is to show you that this trade setup, it hasn't played out. You can take the time after this video is out to look at how it would have played out. Win or lose, it doesn't matter. If we do proper risk management, it doesn't really matter. I'm going to check other examples to show you, but I just want to drive home the point here. So look at this move. This price move, that price move from this level to this level, that had the histogram moving all the way up here, very high. You can see that the reason for this is because price moved from all the way down here to all the way up here, which is a move of like around 168 pips, 168.2 pips. And it it made this move in 12 bars. And since we are on the 1 hour chart, this 12 bars, it actually showing you that this 160 or 170 pips move that we had, price did it in around 12 hours. Okay, but take a look at what we have here again. Price moved from this low, which could be classed as a retracement here, and then it moved all the way to this level here, which is a move that is even less than the 168 pips that we had earlier on. But then price, it took it around 38 bars to do that move. So obviously the oscillator is telling you that the momentum behind this move is not as strong as the momentum behind this move. And so that's the reason why you see that the oscillator is forming highs here, which are much higher than the ones that is forming here. Ideally, if you've attended any of my divergence trading classes, what you want to see on the chart is price should be mimicking, the oscillator should be mimicking what price is doing. So if price is forming higher highs and higher lows, okay, obviously this is a higher high and higher lows, you want the oscillator to also be forming higher highs, higher lows, higher highs. But then in this case, you can see that price, this on the price chart, this high is higher than this high. But on the oscillator chart, this high is lower than this high. This is because the oscillator is telling you that, look, the momentum behind this move, this price move, is not as strong as the momentum behind this move. So even though the market is technically still in an uptrend, it's actually, this move is actually, the momentum behind this move is actually not as strong as the momentum behind this move. So the buyers might be getting weak. And so you should be getting ready to take a trade, a reversal trading position in the opposite direction of the trend. That's all these oscillators are trying to do. That is all they are trying to tell you. So if I was to trade this based on the way I use the MACD indicator, first of all, one condition has been met, which is price is forming higher highs and higher lows. So obviously the trend is still moving in the direction of the uptrend, but the oscillator is showing us that, look, it's not just that the oscillator is falling, showing us that there's a disagreement between price and the oscillator. No, like I explained to you how the oscillator calculates these readings that it does based on the momentum of the move and whatever the case might be. This is the oscillator's way of just telling us that, look, the momentum behind this bullish move is not what it was around here. This particular momentum for this particular move is not as strong as what we had here. So maybe the buyers might be getting weak and maybe a reversal is just around the corner. And so as a result of this, if you want to use it the way to give yourself extra benefit of catching low risk high probability trading opportunities, this is you just take this as a warning signal. But then what is the nail in the coffin? You want price to, as it's forming higher highs and higher lows, you want price to reach a point where it fails to continue forming higher highs and higher lows, and then it starts forming lower lows, a reversal in the market structure, change of character, lower lows and lower highs. And when that happens, then you're going to take a trade in the opposite direction of the trend, because the oscillator has given you this early warning signal. Price has also shown you that the momentum is weakening, and so the change in character or the reversal in the direction of the trend is the nail in the coffin, because it's solid. It's just confirming to you what you've been warned about by the indicator and price action and momentum earlier on. That's all this is. Okay, so let's use an example that already happened on the chart of a couple of trades which would have worked out and a couple which would have not worked out. Okay, so here, what do we have here? Oh, let's start from all the way here. Okay, all the way here. I know I'm cherry picking here, but again, it doesn't matter, because I tell you that, look, even if I cherry pick, I'm telling you that 100% of the trades you take, regardless of how I try to sugarcoat the strategy or whatever the case might be, they're not going to be winning trades. And even if you have a win rate of like 90%, if you don't practice proper risk management, it's all going to be useless, because one losing trade is just going to eat away all of the profits, and you might have a big win rate to tell people and whatever, but you're still in the negative. You're not even making money. Okay, so moving on. Now, what did I tell you about momentum? Remember, you can see that this move, or let me drop this. Let me drop this. Okay, you can see that this move, price moved from all the way, or let's even start from here. Price moved from all the way up here, and then it came all the way down here, which is the lower low. Okay, and this particular move, price moved from all the way up there to here, which is a move of around 126 pips. And then it made this move in 15 bars. Since we're on the 1 hour time frame, that would have been like in 15 hours. But then you can see how the histograms drew this move here, okay? Now, what about this? Price retraced a little bit here, and then it moved violently, aggressively, okay? To here, from all the way up here to all the way down here. This move, compared to this move was around 126 pips, and it did that move in like 12 hours. What about this move? This move was around 155 pips, and it did the same move in how many hours? 12 bars. That's like 12 hours. So you can see that since this move, this indicator is showing you that this move, in fact, there's still strong bearish momentum in the market. So this is what this indicator is showing you. But then, when price retraced a little bit and then price tried to continue moving down, look at what happened. Price moved from all the way up here to all the way down here, basically testing this previous low. It couldn't even go below it. And it did this move in how many hours? Around 3 hours. So this move is around how many pips? Around 80 pips. And this move was like how many pips in just 12 hours? So this move is nothing to write home about. And that's why the indicator, the histograms of the MACD indicator, they are way up here. Remember, I told you that what we want to see on the chart is when price forms higher highs and higher lows, the MACD should also, the oscillator, not only MACD, it should also form lower lows and lower highs. But in this case, you can see that price moved from all the way up here to form this low. And then when it retraced and formed a higher low, it moved and formed this low. But this low is equal lows. It's not lower than this previous low. Since this is equal lows, what we would have wanted to see on the MACD indicator was for this histogram to also be equal to the previous one. But because the momentum is different for this move, and the MACD indicator is basically telling you that this downtrend, even though it has been strong for quite some time now, right now what we are having on the chart is like this momentum, the momentum behind this move is weakening considerably. And so we have divergence here. And what did I tell you when we have divergence? We don't just take a trade. This is a reversal trade setup. So the MACD was warning us. The momentum on our price move was also warning us that this downtrend that we have seen is beginning to weaken. And what would have been the nail in the coffin? This would have been our lower high. So we would have waited for price to break above this lower high, retest this lower high, and when we had the formation of a bullish engulfing candlestick like this, we would have taken a trade setup, a bullish trade setup at the close of the candlestick. If we wanted to do an aggressive stop loss, it would have gone here. If we wanted to use a conservative stop loss, it would have gone below these lows. Because if for whatever reason, after we get into the market with this trade, price was to come all the way down to break below these lows, then we no longer have a valid trade setup. We'll just take our loss and call it a day and wait for the profitable trade setups. And you can see that price would have moved all the way up here. In fact, this would have been on Friday. If we would have taken this trade at the beginning of the week, you could have seen that price would have been seriously in our favor. Okay, so this is an example of putting all the things we've learned together into a trading and creating a trading confluence, okay, of events backing our trade setup. And you can see how beautifully it would have played out. Does this mean that every single trade setup you identify using this technique is going to be a winning trade? Obviously, I keep saying this. No, it's not. And that's why risk management is important. So assuming you took the trade here and your stop loss was somewhere around just below this low, this is the aggressive stop loss. If you are using the aggressive stop loss, you're going to have a lower win rate because price is going to hit your stop loss. Because your stop loss is very close to the current market price, price is going to hit your stop loss way often. But the pro of that method is that you're going to have high reward to risk ratio trades. So assuming you took the trade setup here and your stop loss, the market, I think, let me do this. So assuming you took the trade setup around here, okay, and your stop loss was basically below here, you can see that price would have moved all the way to around 10 out of what you are risking. So if you're risking 1% of your trading account capital per trade, which is the recommended risk per trade, you would have even made 10 times that amount if you held on to the trade. But if you're using the conservative stop, your stop loss would be a lot further away from the current market price. And so your win rate is going to increase a little bit. But that also has the disadvantage of you having lower reward to risk trade. So if you would have held this trade for the same amount of time that the person who took the trade with this tight stop loss held it, you would have only gotten around 6R for this particular trade. Okay, so this is our first example. The second example is this one. Again, you can see what is the momentum. Remember, I told you, even without the indicator, I want you to understand that that this indicator is just basically showing you the momentum of price moves. If you understand this, even without the indicator on your chart, you can look at candles and see the momentum behind price moves. Okay, so for this particular one, you can see that price moved from all the way down here to all the way up here. How many hours did it take it to do this move? Well, considering that the market, we had the close price and everything, but you know, when the market is open, that's when we're just using this for this calculation. You can see that price moved around 300 pips in 11 hours. And that's why the histograms went bonkers around here. And then price did something similar here, okay? Price moved around the same 300 and something pips, but it took it way longer, around 40 something hours compared to the 11 hours of this one. And so you can see that the momentum, the histogram started to die down a little bit. And so we started having the formations of divergence in this market, okay? Okay, we started having the formation of divergence in this market. You can see price is forming higher highs. Yes, the trend is still up, but it's getting weaker and weaker and weaker. So as divergence traders, how would we have approached this trading? This opportunity? You can see again, we had higher highs and higher lows, but the histograms were forming lower lows and lower highs. So as divergence traders, we would have waited for price to break below this low, and then when it retests this level and gives us something like a bearish engulfing candlestick like this one, if you're using the conservative stop loss, you would have had your stop loss somewhere around here, and it would have been taken out here. Okay, but remember, I told you, if you're using the conservative stop loss, your stop loss is going to be tight, but the positive side of that is that your reward to risk is going to be higher. Okay, so even though your win rate is going to be smaller, the profits you're going to be making, the average profits you're going to be making from your winning trades are going to be way bigger than your losses, and so it's going to compensate for it. So in this particular example, if you use the aggressive stop loss method, your stop loss would have been just around here, and this trade would have hit your stop loss. But then the person who is using the conservative stop, his stop loss would have been above these highs. Because if price, for whatever reason, after we enter into the market with a short trade here, comes all the way up here, we are no longer in a downtrend or a reversal or whatever the case might be. We'll just take our loss and call it a day. So in this case, you see that the person who is using the higher, the conservative stop loss, this trade would have given him a profit of like 1:, let's see, around 1:4 or 1:2 if you had held it. But then the person using the conservative stop, even though he would have taken the loss here, as price set up another short here, around here, at the close of this bearish engulfing candlestick, he would have taken another trade setup with a stop loss here. And again, this would have been an easy 1:8 trade. So it all depends on what you're comfortable with. Okay, it all depends on what you're comfortable with. Again, this class has run for way too long, and it's because I really just want you guys to understand this logic. Okay, it's not rocket science. In trading, you just, like, they keep, the pro traders keep telling us, cut your losses short and let your profits run. That's all you're trying to do in trading. Okay, you want to cut your losses and let your profits run. And when you do that successfully, eventually, you know, you're going to become profitable. Okay, so before we wrap up this class, I would like to use this opportunity to let you guys know about our ITU trading robots, which are designed to do all of the heavy lifting for you. They will identify low risk, high probability trade setups on your behalf, take those trades for you, manage their risk based on our recommendations if you follow our step-by-step tutorial to set everything up, okay, so that they will get you earning while you're learning as fast as possible. So if you're interested in them, please reach out to us in the comment sections or any of our social handles, and we'll be more than happy to assist you set everything up the way you're supposed to do it. Okay, so once again, thank you for taking time out of your busy schedule to come to this class. I look forward to seeing you guys in next week's edition of the IT Forex class. Go out there and crush the market. God bless you all. Cheers.